So hi, my name is Jennifer Spooner and I'm the managing partner with BDO in Orlando and also the president of ACG Orlando. And so for those of you who do not know, there are 4 ACG chapters in Florida: Orlando, North Florida, South Florida, and Tampa Bay. So statewide, we have about 700 members, and where each chapter has its own membership and events, we host an annual Florida Capital Connections around the state each year in November. So this year, the event is scheduled at the Ritz-Carlton Amelia Island, and registration is now open on the acgflorida.com website. So of course, we're monitoring the situation. We'll keep you updated on any changes to the event. I also wanted to remind our ACG members that ACG Global is hosting a complimentary virtual ACG member summit on June 23rd and through 25th next week. So I encourage you to register to attend, as you can come and go as you want during the 3 days. And also, if you're not a member, you can join your local chapter today and take part in the summit that has over 1,500 members registered. So our webinar series, Navigating the Pandemic Through the Eyes of a Private Equity Lens, it's a joint effort of the chapters to provide some relevant virtual content through the pandemic. And so before I turn this program over to Sherry Costantini, who is the CEO for Avant Healthcare and our moderator for today, I just wanted to remind you that the last session in Navigating the Pandemic Through the Private Equity Lens series is scheduled for noon on Thursday, July 2nd, and it's going to focus on independent sponsors. So in today's session, we are going to discuss exit values, and now I'm going to turn it over to Sherry. Sherry?
Thanks, Jennifer. Yes, my name is Sherry Costantini, and I'm the founder of Avant Healthcare Professionals, and I'm happy to be with you today. I actually founded this company about 17 years ago and have had private equity in the business, and then recapitalized the business in 2017 with a strategic partner. And so have certainly gone through some of the things that we'll be talking about today relative to timing and optimal timing, if such a thing even exists. But anyway, that's a little bit about me, and I'd like to turn it over now to Valentina to give an introduction.
You're muted, Valentina.
Okay, is that okay?
Yeah.
Great. My name is Valentina Madura. I'm a Senior Managing Director with BDF Capital Advisors. I co-founded the practice back in 2002, and we focus on middle market M&A, specifically servicing privately held companies, family-owned businesses that are looking for some sort of either shareholder transition or liquidity event that could include sell-side M&A, buy-side, and or recapitalizations, fairness opinions, and anything that helps through the thought process of a potential exit event.
Great, thank you. Paul.
Yes, Paul Vogt. I'm with PCE Investment Bankers. We're an investment banking firm and valuation firm. I lead our valuation practice, and we perform valuations for financial reporting purposes, tax purposes, anything M&A related. Business owners looking to sell might want a better understanding of the value of their business, so we help out there as well.
Great, thank you. John, you could introduce yourself.
Yeah, great, Sherry. Thanks for having me. John Capel, Managing Partner at Hidden Harbor Capital Partners. It's a firm I founded about 4 years ago with 2 other partners. We're currently investing at the $265 million first fund. We buy businesses primarily in industrials and business services, between $5 and $25 million of EBITDA, and primarily founder-owned businesses, corporate carve-outs, and family office-owned businesses.
Great, thank you. Matt.
Yes, hi. Nice to meet everybody here. My name is Matt Joblove. I'm the Vice President at Sun Capital Partners. My primary responsibilities are to source new acquisition opportunities, execute those deals, and ultimately sell those businesses. For those of you who don't know about Sun, we're a private equity firm. We're based in Boca Raton. We also have offices in New York, Los Angeles, and London. We manage about $8 billion of assets and are currently investing out of our 7th fund, which we just raised, which is $2.3 billion. And we focus on 4 sectors: consumer, healthcare services, business services, and industrials.
Great, thank you. Thank you all for being here today. Valentina, maybe if I can put it back to you and just if you can tell us what you're seeing in the market right now with COVID-19, that would be great.
Sure. So, you know,
Valentina, we
the
can't hear you.
overall, I am not muted on my
Oh,
end.
you're good now.
Okay. So I think what we've seen as a result of COVID-19 is really this seismic shift going from a seller-friendly environment to a buyer-friendly environment in terms of deal structures, deal conditions, and largely the deals that we're seeing right now are distressed deals or any type of deal that's primarily driven by liquidity needs. I would say that the deals that we are seeing that are still in the marketplace that are based on companies that are continuing to perform through this pandemic, what they're up against is, you know, a question of valuation and a question of how those deals are structured. So from a valuation perspective, you know, buyers have been great about honoring pre-COVID-19 multiples, but the question is, what do you apply that multiple on? And when you look at a valuation for a company, you know, the valuation fundamentals are broken. So you can't really look at the EBITDA because you can't project what that EBITDA is going to be through 2020 or 2001. And if you can't project out the EBITDA, you can't calibrate the risk. And that's how a buyer ascribes either the multiple or you know, different factors in the valuation model. And so without that, we have this dislocation between what the buyer thinks is the value of the company and what the seller thinks is the value of the company. And so there's not that meeting of the minds. And what you're seeing is that a lot of deals are falling apart because of that, or they're in a wait and see mode. And what buyers are trying to do, and I think sellers are appreciative of this, but I think it's still leaving some sort of a gap, is that buyers are then saying, all right, we'll try to honor that valuation because we know that your performance today is not indicative of what it will be post-COVID-19. And so they're looking at different ways to structure the deal. And that structuring is primarily to shift cash at close to some point in the future. So what we're seeing is we're seeing earnouts, we're seeing seller notes, equity from a deal with a private equity firm. And the other way they're doing it is they're doing it structurally through the securities that they're including in the deal. So instead of just, you know, having a pari passu deal with a financial sponsor where the seller and the buyer are both going to share or have an investment in the same stock, you're going to see convertible preferreds or participating preferred stock being used in transactions to help those buyers protect themselves on the downside. So on the one hand, I think everyone is trying to be as creative as possible to structure the deal to meet valuation expectations that the sellers had or address kind of this business interruption that people are going through. But on the downside for a seller and how this shifts us into a buyer's market is those tactics result in either less cash at close, overall proceeds, or in the case of different security structures, what it's doing is it's kind of putting a ceiling on the equity appreciation that the seller can receive, but moving that appreciation over into the buyer's hands. So I think that's the biggest shift that we've seen is just, again, how deals are being structured, how the deals are being valued, and most importantly, why you're not seeing traditional M&A getting done right now, or it's, you know, specific to industries, that you're starting to see just those deals that are driven by liquidity needs kind of push forward to a close.
Paul, can you comment on what you're seeing in the market?
Yeah, similarly, we're seeing the same sort of thing. We're seeing some transactions moving forward, albeit a bit slower. And of course, we're seeing definitely some pause on some LOIs that had been entered into. And I think everyone is just kind of waiting for the dust to settle before they move forward on those transactions. And that is dictated by the industry as well. So, you might expect construction industry, for example, might be an industry where you see some slowdown. Other businesses that have been surviving through this have been faring pretty well. So you'll see those transactions move forward. And similarly, we're seeing from the financial reporting perspective, we're seeing more earnouts and a little bit longer earnouts as well. I've even seen some recently that have gone out for 5 years because the sellers, will insist that they're going to rebound and get back to normalized levels of cash flow. So I think there's some skin in the game on both sides that we're seeing more often. And in terms of multiples, I think we're seeing some downward trend in multiples, but it's a cash flow again. What do you apply that multiple to? Obviously, the latest 12 months isn't going to be a great metric to use. So we're looking at next 12 months, 2 years out, and the concern is maybe there's a wedge, right? You had your original cash flow projection, and now there's a wedge where you now have this new cash flow projection that's below that. So are you going to see a rebound back to that original cash flow, or is it going to be a constant wedge going forward where you're going to see this delta in that EBITDA? And so that, that's the risk that is being captured into the valuations that we're working on today.
Okay, great. Thank you for those perspectives. John, if you can comment from the PE side.
Yeah, I think what we're seeing is there isn't a market, that 90+% of deals have been pushed off or not closed, or just there's not much going on, truthfully. And there's sort of two different states. There's businesses that have really kind of powered through COVID-19 and have had little or no impact on their business. And I think there are absolutely still buyers of those businesses, both on the strategic and financial side. There's less debt available. I think there are some equity firms that would bridge that and not really worry about it. But frankly, there's just kind of a lack of sellers, right? I mean, if you have a really good business that's powered through COVID-19, why launch a process now? Why not wait till the second half when, financial markets are likely more open and there's more debt available and there's just likely to be a more robust process? We're hearing about some processes restarting, but I'd say it's very much kind of toe in the water at this point. And then the other set of businesses are those that have been impacted by COVID-19, either positive or negative. And the truth is on all those is you have no idea what the EBITDA of those companies is. And buyers will almost always take in the presence of risk and the presence of uncertainty, buyers take the low case every single time. And so it's going to be very difficult to transact on those businesses. I think even in the back half of this year, I think, it's really going to take till 2021 when you can start to get a real good ongoing sense of what those businesses are going to do. And so the businesses you're seeing now that have been impacted are those that have big liquidity needs that existing equity and debt aren't willing to fund. There aren't very many of them, and they're usually pretty ugly. And so, right now, I think, we're sort of staying active, talking to people, doing a lot of things, but the only true deal activity we have going on is primarily on the add-on side, and they're primarily smaller.
Okay.
In industries that haven't really been impacted.
All right. Well, thank you, John. Matt, is that consistent with what you're seeing in the market, or?
Yeah, totally. I'd echo a lot of what John mentioned. The overarching theme from what we're seeing is this is an unprecedented situation, right? The market is still digesting what's going on here, and it's still happening in real time. So the effect of that has been a slowdown in M&A activity. And really, unless you have to sell your company right now, sellers are probably choosing not to until things stabilize. So we totally agree with all the sentiments thus far.
Okay. Well, let's just, specifically talk about valuations. Paul, I know you touched on this a little bit, but is there anything that you want to add specific to valuations related to COVID?
Well, as I mentioned earlier, I think we're just seeing more risk factored into those cash flows. The company provided a set of projections pre-COVID. Obviously, everyone is, taking a different look at those. I think, this was mentioned earlier, what is EBITDA going to look like at the end of the year? What's it going to look like for 2021? And so there's just so much uncertainty there that, we're seeing more scenario type analyses, best case, worst case. I know that's, kind of always been factor in the past, but I think there's even more prevalence into looking at that sort of scenario.
Okay. Matt, anything else you want to add on valuations, which you've personally experienced or the firm's seen?
Yeah, I'd say that the reality is there just hasn't been enough activity in closed deals at this point to give you a concrete view of the impact to valuation. There have been comments made by some of the other panelists at this point that I would agree with, that we at Sun, we are trying to be as creative as possible to provide full or close to full value, whether it's looking at a normalized EBITDA, for example, or structure of some sort. So, but really the reality is it's just too soon to know the long-term impact of value based on where we are in the virus.
Anything else you'd add to that, John?
Yeah, I mean, who knows, right? I mean, Matt said exactly right. Like, we can talk all we want, but not many deals are closing, so who the heck knows what's really happened to valuations? And like Matt is, we're about to do our Q2 valuations, and it's tough to say. The equity markets obviously look pretty robust, so that would suggest that I think, at least multiples that if you can get to 2021 or 2022, I think there's a hypothesis out there that multiples are likely to return to something like they were before, if. And so I think as long as there's that hope out there, it's hard to believe that lots of transactions are going to get done in the near term at any kind of lower valuation. I know that for our businesses that are really seeing, strong EBITDA and strong financial performance through this, the sense we're getting from the buyers and the bankers out there is that, hey, they think those businesses will trade for nice multiples and maybe even just as good given how well they powered through this. And so, but we just don't know. I mean, I think it's all hypothesis. I talked to a banker yesterday who's about to start their first kind of post-COVID-19 process. And he said, hey, we're going to send out books, get indications, but there's a decent shot we just pull it after indications if we don't kind of hear what we want to hear. And so, the question is, when is everyone going to dip their toe back in and start doing deals? And I think equity is frankly kind of more ready than debt is. And both of those are more ready than the sellers are, who just sort of say, why not wait until the fall? What's the hurry if you have a good, well-performing business?
Right. Well, I think that brings us to the next question, which is, what's the impact on hold periods? And Matt, maybe you can talk a little bit about that.
Yeah, happy to. So I'd really put it into two buckets. So if you are a healthy company and perhaps you're gearing up for a sale, perhaps this extends your hold period, right? Because you might want to see things stabilize. The flip side would be maybe you are getting pinched right now and you're seeing liquidity pressure due to the virus. And so this could actually accelerate a sale more quickly and shorten your hold period. So I'd say it's almost a tale of two cities based on the health of your business.
John, anything to add to that?
Yeah, I think for private equity, it likely slightly elongates the hold period, as you said, for well-performing businesses. At a minimum, it pushes you back 6 months. For cyclical businesses, we're likely to do a cycle here, even once we're out of COVID-19. And so that pushes things back on some things. Everything we've bought in the last 3 to 4 years, we've assumed a cycle anyway. And so maybe that's fine. I think as you think about the overall deal environment, though, folks have had it great for the last 10 years, right? And so a lot of entrepreneurs that were getting older and were maybe thinking of selling their businesses, they were having some of their best years of their career. Well, that's all changed a little bit now, hasn't it? And so I think you're going to see an awful lot of folks who are just a little bit tired after this and are going to be looking to say, hey, look, maybe I'll take some chips off the table. So I expect to see in 2021 a fair amount of founder sellers and a lot more volume coming out of them. We'll see what happens with private equity sellers, but I expect to see a lot of founder sellers through this cycle.
Valentina, do you have anything to add to that?
Yeah, no, I think John makes an excellent point. We've been actually very active in talking to sellers right now, and I think you've got to bifurcate it into two buckets. So you've got the sellers that were ready to go to market, had already made that mental decision to move forward, went through the process of preparing to go to market. and then the process was just put on hold, come March. Those sellers want to proceed. They were ready to go, and as long as, again, they're performing throughout this downturn, they want to see the company sold, and that's where we're kind of managing the structure of the deal and evaluation, whether or not it makes sense. The other bucket is really those sellers, as John pointed out, that, it's a business that's founder-owned. They're in their late 50s, early 60s. They probably went through the great financial crisis, and now they're seeing this, a health pandemic, and they start to reprioritize. And they really make sense for me either to recapitalize the business and take some, chips off the table through a sale to a private equity firm, or it's time for me to sell the company. So we also see there being a lot of pent-up demand to go to market towards the end of the year. And I'm guessing, again, depending on how everything unfolds, that you'll see a very active 221 M&A market, but especially in the low to middle market, where, again, you have a lot of those independently held family-owned businesses.
Right. Paul, is that pretty consistent with your read?
Yeah, I mean, I think that's spot on. We're, my colleagues on the investment banking side, staying in touch with all their contacts. They know that, same thing. Once we get through this, there's gonna be a lot of pent up demand. These owners are founder owners are gonna be ready to run and just, take what they can get. They've survived two calamities here, and I think they're gonna, there's gonna be a lot of activity I think we'll see in 2021.
Yeah. Okay, well, thank you. So let's talk a little bit about industries and, how industries are doing in the current market. I'll just comment on healthcare. Avant is a healthcare staffing company that specializes in international recruitment. So we staff in hospitals in 40 states. And I'll say that the impact that I've seen on healthcare during this time, it has been just unprecedented, where you have 90% of hospitals that were not able to do what's considered elective procedures and surgeries, which is anything that's not life-threatening. So to see nurses getting furloughed, has been, just really unprecedented. And then you look over at the other side of hospitals that have been in hot spots and just overwhelmed with patient volume. So it's been really interesting, but that's just kind of my insider view on that market. But I'm interested what you guys are seeing in the industry, in various industries. Valentina, can you kick us off on that?
Sure. Yeah, we're generalists, our practice, so we do work with companies across a lot of different industries. And I'll just compare and contrast two deals that I'm working on. So in the construction industry, and I think this Paul alluded to earlier, this market is it came to a grinding halt. People were still working on deals, and in some cases, at least my client who does interior contracting work, they were deemed essential, so they continued to work. But then as time passed, those jobs are being put on hold or they're being extended. And so you can all of a sudden see the slowdown. It's really hitting them more so now than it was two months ago or even 30 days ago. So again, compare that with a software company that I'm working on that's in the EDI space, and they're working with trading partners, and e-commerce right now is going through e-commerce round 2, right? They enjoyed the tech boom, and now if you did not have an e-commerce infrastructure before COVID-19, you most certainly established one over the last 3 or 4 months. That company we're launching into market, actually, we launched them into market this week. We expect a very active reception from the marketplace. Their performance hasn't changed. The equities valuations for potential buyers in the marketplace hasn't changed. And that particular industry is deemed completely essential and needed right now. And so that's the type of deal that we would expect to see go through the process. I don't see us halting after indications of interest, but that could be the case. But I expect that would be a deal that would come to fruition. Whereas I said, you've got the construction market, which is one that, you're just not going to launch deals in the market or even try to, phase through with companies like that. I would say just overall industry, things or trends that we've seen, online education completely boomed in the last 30 to 60 days. It's continuing to boom because parents can't send their kids to school. They don't even know if they'll be sending them to school in the fall. And so, where you have any sort of online education certifications, those sorts of businesses, they've been able to demonstrate their agility in the marketplace exceptionally well. And even though they may have experienced maybe 10 or 15% drop off, they're seeing that that recovery, right now as we come out of this and you see some of the restrictions lifted. Health tech, obviously, you mentioned the healthcare sector. Health tech is absolutely an area where any way that a company can provide services that offer healthcare providers an ability to connect with their patients online, that's a very favored industry. And then even, the one thing that COVID-19, it brought sexiness to the unsexy industry. So you've got, packaging or industrial janitorial supplies businesses that are having record months right now. And so again, those are businesses that we would feel comfortable launching into the market and moving forward with those businesses because we're still seeing activity both on the financial front and on the strategic side.
Great, thank you. John, what are you thinking industry-wide?
What strikes me is how interesting it's been and how this has fallen in ways that nobody would have ever thought of, pre-pandemic. So as an example, I think that, the two most cyclical industries potentially in the U.S. are the recreational boat market and the RV market that are insanely cyclical, and they're both going through the roof right now. Like, I mean, who would have ever thought that? But, people can't get on a plane and go on vacation that way, so they're buying boats and buying RVs, and that market is flying. We have an aftermarket auto business that, miles driven were down 50% for a couple months, and we were expecting to frankly get killed, and we have just powered our way through it. The business has continued to perform great. And so what I've seen just across both our businesses and as I talk to other people is how this has all hit people in very different ways than anyone would have expected. We have a business that manages multifamily apartment communities, primarily for kind of working class areas. We were expecting to have 50% default rates. I mean, the government's going out there and saying, hey, we're not going to evict anyone. And our default rates are up, but they're up like 5%. I mean, it's pretty amazing how people are still paying their rent. So this is all happening in ways we wouldn't have expected. Who would have thought healthcare, which is the classic acyclical industry, all of a sudden has a massive issue? Who would have asked the question that, hey, what happens if we shut all the restaurants down? So I just think it's fallen in a bunch of ways that nobody could have ever expected. And I think it's going to come out in ways that people won't expect. And like all those people that went out and bought boats for the summer, like what do they do with them in the fall? Do they still boat or do they all go sell them? And, there's going to be all sorts of like strange impacts as we come out that I'm not sure I'm smart enough to sort of figure out.
Matt, what do you think of the various industries and what are you kind of looking at and steering clear of?
Yeah, well, I haven't bought a boat yet, but actually that's a good idea, John. Good idea, Johnson. Maybe
it's really hard to buy one. Like literally all the new boat guys are filled up for the next year. If you have a used boat and you want to sell it, by the way, now is the time. Like the market.
Okay, noted. But no, look, from an industry perspective, there's examples with winners, losers, and stability, right? I mean, on the first bucket, the industries that are struggling, I'd say it's consumer-facing industries, right? So, restaurants, retailers. I mean, the government has actually forced these businesses to shutter, right? So it's really impossible to do well. And then in the middle, the second bucket would be, stable companies, right? And you could think of a utilities business that's just kind of, not doing particularly better or worse, but just more steady Eddie. And then there's companies that have been beneficiaries from this, right? Obviously, medical equipment providers, or we know toilet paper had a ramp up at one point. So to John's point, it's just been it's been a little bit unpredictable, and I think we're still going to find out more as we go.
Well, let's talk about opportunities for companies. I know for us as a healthcare staffing company, we know staffing companies in different niches in healthcare have been impacted in a variety of ways under COVID. But we're out there. We have a more stable business model, given that our clinicians go out for about 2.5 years on one assignment. So we're looking for opportunities. We're looking for the distressed staffing companies that, maybe we can take advantage of this and bring some resources to bear. So John, maybe you can comment on opportunities that might be out there to diversify.
Yeah, I mean, I'd sort of say two things. Well, I think the biggest opportunity we've seen is if you have a portfolio company with add-on opportunities, particularly where they're reasonably small. Our business, Stella Environmental, which is an environmental services business in municipal solid waste space. We have 2 add-ons under LOI right now, and we're seeing exactly that these kind of founder owners are sort of done with their issues and happy to sell it. This is a business that's really been impacted, right? So it's pretty easy to figure out what EBITDA is, and they're just sort of ready to move on to the next phase of their life. And so I think those are the best opportunities. It's like kind of, where can you find particularly add-ons in industries where, they haven't been impacted so much, but that folks just want to get out. Those are the biggest opportunities we're finding, and we're not finding them through processes, where banks are bringing them to us. We're doing, kind of outbound searches for those kind of businesses and finding sellers that are willing to transact. So that's where we're having the most success.
Matt.
Yeah, so what's interesting about the distress market at this point is, I think if you really just to listen to the news or see the unemployment rates, you might think there's a ton of distress opportunities, but the reality is we haven't seen that yet. And I'd almost characterize where we are right now as almost the calm before the storm. And the reason we haven't seen the flood of distressed deals just yet, I think, are twofold. The first would be the government stimulus. I mean, the government has stepped up in a major way to provide a lifeline to a lot of businesses. And so that's really extending, their ability to operate, which maybe otherwise it would be a distressed deal. And the second factor is, a lot of these companies have leveraged loans, and, they report to their banks quarterly. So if you think about where we are on the timeline, they had their first reporting on March 31st, which probably just about a month of COVID. The second quarter is coming up here, June 30th. And so every time they have these quarterly bank reporting, they can potentially breach covenants, default, and that will then accelerate the distressed opportunities. So again, I think it's the calm before the storm. Frankly, from a Sun perspective, I'm looking forward to the more opportunities because, we originally actually started as a distressed shop. So I think we'll be well positioned to help companies, navigate these unusual times. So that's how we're seeing it, at least.
Good. Well, I appreciate that. All of your perspectives. I think at this point, we'll open it up to some questions from the attendees. Maybe one I'll just start with is, how are you advising companies that are looking for that optimal time to go out to market? Is there that optimal time? And are you kind of telling them to hold back and get ready and so that when that comes, they'll be ready to move? Maybe Paul.
I'm sorry, can you repeat that? My sound just went off for a minute.
Okay, yeah, so I'm just saying, if you've got companies coming to you, they want to go to market, or maybe you've been working with them and they're waiting for that optimal time. Do you think that there's going to be some windows coming up here as we return to some level of normalcy?
Yeah, that's the $1 million question, right? I just saw some, recent articles, saw one this morning. There's some retailers that are considering shutting back down again after reopening. There's obviously, you see article after article about the increase in cases. So I think there is just a lot of uncertainty still right now. So I think there is going to be a window where we're still going to be in a pause mode. But I think, John mentioned earlier, I do have a lot of clients that are making bolt-on acquisitions, but again, that depends on the industry. So those little smaller acquisitions, in the consumer staple sort of area where, waste collection businesses, I've got a waste collection company, very, a lot of opportunity now in the municipal solid waste collection. The retail side of things, construction and debris side of things of that business has slowed down, obviously. But with everybody being home, there's still, a lot of trash to be collected. So they're making those sort of bolt-on acquisitions.
Great. John or Matt, do you have anything to add?
Yeah, look.
Go ahead, Matt.
Yeah, unfortunately, none of us have a crystal ball to say that we have visibility if we're going to have a double dip in virus numbers. So it's really, really challenging to kind of decide when is the optimal time. I mean, there's some advantages to going to market sooner than later right now. I mean, the obvious one is a lot of people aren't, right? And so if you can go to market now, you're not up against as much competition with a robust deal pipeline, and perhaps you get a closer look from private equity firms, just given the lull. So that's maybe one advantage to go sooner. But I think it really boils down to company specific, trends, how you've done so far, because that's going to come under scrutiny, how you're doing compared to budget versus a prior year, et cetera. So, unfortunately, there's not a great answer there, but if you're doing well and, you want to maybe capture a lull in the market, maybe you could go sooner.
John, anything to add?
Yeah, so the concept of a perfect time is really tricky, right? Because there are perfect times, but it takes 6 months to kind of get to it. So even if it's a perfect time now, if I launched tomorrow, by the time I'm really pricing my deal, it's 3 to 4 months in the future, and I've passed that kind of perfect time window. And so I agree with Matt, by the way. There's an awful lot of buyers with nothing to do right now. There's a lot of financing guys with nothing to do. And so I think this concept of launching now and hoping that by the time you price, you're in a better environment isn't the craziest one. I haven't seen a lot of people do it, but I think it's not a crazy one. I would say that, for most people, I think they just view this as, whatever the environment is today, gosh, it's got to be better in 3 months. And so they're waiting. And the uncertainty is just a bad thing as a seller. You want to be able to deliver certainty. And so right now, I think people are waiting. And I think that's frankly what PE is doing. And I think PE is, we're professional sellers. So I would follow a little bit of that guidance.
So I've got a couple questions here. Would you all advise your clients to use this time to pursue value growth, value enhancement strategies in order to maximize their transition in the next year or two? And I don't, Valentina, you want to comment on that, or John or Matt?
Sure, yeah. So, I think if you're not going to market, and, to John and Matt's point, you go to market when, three things align. Shareholders' time horizon, so when do you want to sell, your particular industry and how well it's doing, and the company, how well it's doing. If those three things aren't aligned, we wouldn't suggest that anyone go to market irrespective of COVID-19 or different times. But in terms of what they should be doing, if you're not going to go to market, you should be looking for value enhancing alternatives. So I know I've been talking to a lot of sellers. In some cases, they have multiple facilities. This is an opportunity to consolidate those facilities, things that they didn't do in the past, but they really should have done, and it'll make them more attractive when they do go to market. We talked about opportunities in the marketplace. I know with a lot of companies, even clients that I have, the question they've asked me is, all right, well, we're going to put this sale process on hold for 6 to 9 months. Should we go out and do an acquisition? Absolutely. If you've got the capital and there's opportunities out there, especially with these industries, regardless of whether or not the overall industry is doing well as a result of the coronavirus, it may just be that the size of that business can't sustain itself, but when you're larger, you can sustain itself. So go ahead and take advantage of those sellers that don't feel as though they can make it through this time in the marketplace and do an acquisition. I would probably say the other thing, which is not so much a value enhancing tactic, but something that all sellers and all businesses should be thinking about, is simply just getting their house in order. So, looking at performance indicators and tracking how the company has performed pre and post COVID. If we go into a double dip, you're going to have to do that exercise twice. But that's the single biggest thing that buyers are going to look at when they come in and they look at a business. They're going to ask how it performed. They're going to look at a forensic level those key performance indicators. So more of that you can share with them, your dashboard of performance, I think is going to contribute to the confidence level they have is how that company will actually come out of this pandemic.
Okay, thank you. Now for John and Matt, we've got a couple questions. I'll put these two together. Do you see private equity returning capital, if not deployed, as a consequence of COVID? And then, maybe as a follow-on, how will this COVID crisis change or impact the PE industry?
Now you want to start or want me to start? Yeah, so in terms of capital deployment, my sense is, at least when we talk to our investors, they understand that right now we're not deploying capital, that they're fine with that. They're not pushing us to sort of increase deal flow right now. And my guess is that will mean they're more likely to want to extend, investment terms at the end of the investment period. But we'll see. But I don't see folks returning capital. Generally, private equity, kind of likes to invest capital that it raised. In terms of how the PE industry changes, I think the big thing is how useful these kind of Zoom calls can be versus in-person meetings. So if you look at 2019, we visited over 50 companies, and that took an extraordinary amount of time, effort, and cost, frankly. And so I think you're going to start to see more and more Zoom calls earlier in the process that frankly just, it means a lot less investment by both the buyer and seller, so that we can more quickly early in the process really kind of get to know each other and evaluate whether it's a good fit. And so I'm not sure the bankers have all figured out exactly how to do that, other than as I talk to them, they sort of feel the same thing, right? And if we were going to go sell a business now, rather than getting initial indications and having 10 folks come to meet us, half of those folks generally don't do any work after that. Hey, why not have 12 or 15 Zoom calls that are an hour each, and then really choose the 5 folks that are most interested to kind of come in and really dig in. And so I think there's going to be real changes in the deal process kind of going forward.
Matt?
I really don't have much to add. I think John said it well to both parts of the question. Part of me is thinking, right, will this pandemic make us think about risk differently, right? When you look at new opportunities, we would always look at 08, 09 as the kind of barometer of worst case scenario. And I think we've learned in this process that, there's other risks and ways your businesses could be impacted, right? So I think it's gonna be difficult to, ever do a deal if you think that this is gonna happen, halfway through your whole period. You can't take that maybe negative view per se, but I do think it's gonna create good debate and dialogue in our investment committee discussions to think about how businesses will do under different circumstances.
And Matt, I do think there's a bunch of folks out there that seem to have forgotten how cyclical some businesses can be. And, I do think it's going to, we haven't had a cycle in 10 years now. And so I do think that, people are going to rethink buying cyclical businesses, and that could drive valuation there.
Well, along the lines of some of the comments you made about how this might change the deal process, here's another question. How is the uncertainty affecting how you will conduct due diligence? What additional due diligence do you conduct around employee practices involving COVID-19?
Yeah. So look, I think that to John's point, just in terms of diligence, you could actually do a lot of it remote. That's the beauty of what we're learning through this. So, obviously, if you wanted to walk a manufacturing plant, you got to be there in person. So there are limitations. But If you're doing a quality of earnings, instead of doing it on site, could you have your accounting firm host it in this type of fashion? So I think that you probably could still do the majority of your diligence in a virtual way, but there are just in-person elements that probably need to take place as well.
Anything to add, John?
No, I think that's right. I mean, we haven't really. I don't think very many people have closed a sizable transaction since this started. So, our industry tends to follow the leader, and so I'm not sure who's really thought that through yet. But yeah, you're going to want to ask some basic questions around how are you handling COVID-19 and what's going on. I think there's a reasonably standard playbook out there that most folks are following, and I'm not sure anyone's really figured out whether there are large liabilities that companies can get sued for related to COVID-19. So I'm not sure we've just kind of figured it out yet.
Okay. So one of the questions is that we had mentioned that evaluations are coming down, and this person had asked that this may be industry specific, and can we comment, maybe Valentina, you can start on software technology valuations.
Yeah, so, valuations are a function of a lot of different things, but if you look at the cycles in the marketplace, and we say we haven't, cycled in 10 years, generally M&A started to go down, or at least middle market M&A in 2017. So M&A is a precursor to a downturn, it's a precursor to an upturn as well. So we started to see those multiples kind of, percolate a little bit, going up and down, and starting to see some variability in the deals that we were doing. So we fully expected that we were going to see, some downturn in the valuation. It's incongruent with what's happening in the equity market right now, but we expect those valuations will go down. And the other function of the valuation is really the competition in the marketplace. So this is something that, both John and Matt have mentioned. If you have what we would have referred to back in 2010, 2011, a scarcity premium, meaning that there really aren't that many good businesses there. And let's remember that we had a health pandemic, not a financial crisis. So everyone still has all the capital they had before. If you do put a good company out there in the marketplace and there's nowhere else to invest your money, presumably that particular company could garner an extremely high valuation. Now, there's a lot of speculation there, right? I mean, have we done it personally? No, we haven't launched any new deals in the market since COVID-19, with the exception of the software company. We'll see how, things unfold. But I also think that's an exception because that particular industry really has not skipped a beat since we've gone through all of this. And I don't think there's any lingering impact to that particular industry other than it could only go up. And so I think the confidence level between buyers and sellers is fairly strong in that industry, whereas every other industry, when you look at it, you even have companies that in some cases were taking negative adjustments to EBITDA. They've done so well because of COVID-19, we have to adjust it downward because we know that that's not sustainable. We know that that's what the buyers will do as well. So I think generally we were in a market where we're going to start to see valuations start to go down, and then eventually when we come out of it, they'll go up. But I think it'll be largely dictated in today's environment by how strong the company is performing, how many buyers are interested in buying that particular business, and what the competitive tension is in the process.
Thank you. One of the questions is what is the impact, or what impact are you seeing in the use of rep and warranty insurance? And I know we've talked about that there's not been a lot of deals going to market, so maybe even what do you anticipate? John, you want
COVID-19 being carved out of rep and warranty insurance, or pandemics in general, right? I mean, rep and warranty insurance has now become the standard in our industry. Almost all private equity buyers use it on almost every deal. So I don't see that changing. It makes a lot of sense. It makes the deal process easier. Sellers don't have to put as much dollars into escrow, which they don't like, et cetera, et cetera. So I think it'll continue to happen.
Matt, any additional thoughts?
Nope, I would agree.
Okay. All right. Let's see, a question says, do you foresee a large increase in purchases of minority in ownership? If so, would you purchase that ownership at a discounted multiple? And do you foresee potential buyers to co-op on purchases to decrease risk?
Yeah, I'm happy to take the lead on that. So I would say yes. I do think that there will be an increase in minority deals. For example, that's something that we're considering. If you think about you're a seller and perhaps you feel like you're selling at the low point right now, well, hey, we'd consider just doing a minority deal instead of, and giving you more upside to better days. So I definitely think it's a way to structure things and still do deals in this market. In terms of whether or not it would be a discount or not, I think it really just depends on the situation. Is there a path to majority? Is a plan always to be minority? So I think it is case by case, but 100% I do think that minority deals is something that will take place, and it's something that we're doing.
Here's a question, maybe John, if you want to take this. How much weight are you giving to public multiple comparables for your Q2 portfolio valuations? Are you putting more weight into your DCF valuation analysis?
This is an excellent question. I don't know, right? That's the truth, right? Like, I think no one, and I'll answer here from Matt, but we don't know how to value our businesses right now, right? It's really hard to figure out exactly the right way to do it. We're going to probably wait till June numbers come in, run our more typical approach, and then see if we need to change it at all to make them to just make it make more sense based on where we really think. But that's the logical thing to do, right? I mean, I will say that there's two different worlds. There's this valuation world, and then there's the how we really buy businesses world. And in valuation, these public comparables are a big piece of it. But I don't know what Matt thinks, but we don't really spend much time with public comparables when we're buying a company. Generally, there aren't comparables that are really all that comparable. The ones that are there are 10 to sometimes 100 times bigger than we are. There's just not a lot to be learned by kind of those public market valuations. We use them for our valuations and our marks because that's what our auditors tell us we have to do. But it's not really part of the kind of deal process. And then we're going to have to figure out what to do in terms of valuations this quarter. And we haven't figured it out, and we're going to probably go to our accountants and spend a fair amount of time on kind of what everyone's doing.
Yeah, the only thing I'd add to that, John, is we look at public comps as a data point. I don't think it necessarily is the ultimate driver evaluation. We look at a lot of data points, right? But the reason why I think public comps are even more watered down right now is just look what's going on in the public equity markets, right? I mean, if you looked at the public comps maybe 2 months ago versus where things have trended up now, you could think the multiple is a very different story. So I totally agree. It's tough to really anchor into a public comp, particularly right now.
Yep, agreed.
Well, I'm going to read this last question, and maybe if everybody could go around and give their thought on which markets would be most impacted. So going through this pandemic has changed how many people see things, more comfortable with video calls like this one, more home deliveries, restaurants with more pickup. Which markets do you see most impacted by these disruptive market changes? Paul, if you want to start with one market.
Yeah, I mean, I think the home delivery market, I remember that years ago, there was a company that tried to start this that didn't make it. I think that was just premature. People weren't ready for it. But I think now, just the logistics, people staying home are starting to feel more comfortable with that type of market. So I think that one is going to continue to grow. And, you'll see that expand. I think, markets like Zoom and, some of the supporting IT companies that are going to allow people to continue to work from home. You're going to see those continue to grow because people are going to, have a need for that. So, we have a client right now that is going to market in the cellular space. Just a huge market there. People are, using Wi-Fi, cellular more as they work from home. So we're going to we expect that one to go out at a pretty decent price.
Valentina.
Yeah, I'd probably say online education, and you can see what's happening, elementary education all the way through to colleges and universities, potentially moving all of their offerings online. I think that is, I don't know if that's going to change for the foreseeable future and then, beyond that, and what it would do to the entire industry. But I know through personal experience, I know through talking to companies that are in this space, those businesses are doing exceptionally well. And I think I've even heard from both participants and parents that their kids are more focused on, an online session than they are when they're in the classroom. There's less disruptions. You're not looking at the person sitting beside you. So I think, again, that those online offerings, elementary age to middle school, I think that those things are going to take off because they're very viable offerings. And I think with Zoom, with other types of tech offerings that are enabling the online learning platform, I think it's becoming much more accepted and widely accepted.
Matt.
Yeah, I would say home improvement. If work from home becomes a thing to stay, or even a larger part of our work week, I think people are going to want to spend money to improve their homes. I mean, we're staring at our four walls a lot right now, and I'm looking around and things I might want to improve on. So I think home improvement is going to be a space that's going to see some nice tailwinds.
John.
I was going to say my kids hate home learning, so it has not gone over well in my house. But I do know, but it's all kids learn differently, right? It's interesting. I think the businesses, in industrials and business services, we probably haven't been as impacted as things like consumer and healthcare and some of the other industries. I think that those industrials and business services kind of subsectors that really powered through this, and aftermarket auto, municipal solid waste, some of those kind of things, I think are going to get very, very hot in the next year or two. I think investors are going to really look for things that, even in this environment, sort of tended to perform well, tended to really do well. I think that industries that historically have had that, aura, and healthcare is a classic one, but things like food distribution, which you'd think we should have powered through, but if you did food distribution to restaurants, you got destroyed. And so I think a bunch of those industries that have historically kind of had that aura of, hey, these things are nice, steady Eddie businesses, are going to really trade down when they weren't steady Eddie through this thing. And so I think that's a big change you're going to see, at least in our markets. And, then we'll just see. I think a lot of more things are going to get sold online direct, and that has all sorts of channel issues.
Thank you. Thank you all. Jennifer, let me turn it over to you.
Thanks, Sherry. I think we've had some really great questions and really good discussion here. So I want to just thank you and the panel for all your comments and thoughts today. And thank you all for attending today's session. I want to invite everyone to join us for our last session in the series that's going to focus on independent sponsors on July 2nd. And I encourage all ACG members to attend next week's virtual member summit. So we hope you have a great afternoon. Thank you.
Thanks, everyone. Thanks.
Bye.
Thank you.